Hey everyone, thanks for joining us today. I'm Megan Coelho. I'm the president of Advice Chaser. And before I introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. And I also would like to add, views and opinions expressed herein are those of Corrine Blake and Jennifer Shea, JD, and do not necessarily represent the views and opinions of MML Investors Services, LLC. The information presented is not intended to provide investment advice, and no one should rely on the views and the opinions expressed herein in making investment decisions. We're thrilled to bring you this educational presentation today. Attendees are muted, but we encourage you to ask questions in the chat box. If you ask a question there, do go ahead and leave your contact information so that if we don't get to your question during the event, we can make sure that someone reaches out to you after. We want this experience to be as educational as possible for you, so please don't hesitate to ask for clarification or expansion of the material. And I'd love to introduce you to today's presenter, who is Jennifer Shea. She's an attorney by education and heads up the Estate and Business Planning Department at Bay State Financial. In this role, Jennifer partners with financial advisors to provide subject matter expertise to help identify and create customized solutions for clients. Jennifer is well-versed in all areas of financial planning and has developed particular expertise in the areas of estate planning, insurance, philanthropy, and retirement. Jennifer received a BS from the Pennsylvania State University, JD from Syracuse University College of Law, and MBA from Syracuse University School of Management. Prior to joining Bay State Financial, Jennifer was a senior planning specialist at Merrill Lynch and as an associate at a boutique trust and estate law firm in Boston. And our moderator today is Corrine Blake. She is a registered representative and financial planner with Bay State Financial. Corrine has provided insurance and financial advisory services to individuals, public school teachers, and local labor unions for more than a decade. Her clients are confident about their financial future because she understands their goals and has built long-term trusted relationships with them. She has written for Unity First magazine, and she's a regular contributor to Brockton Parents magazine. Corrine has a Bachelor of Science degree in accounting from Pennsylvania State University and completed Boston University's financial planning program. She continues to participate in advanced courses on estate, tax, investments, and risk management, and she regularly conducts corporate and college seminars and community roundtable events. So, Corrine, I'm going to go ahead and pass the torch over to you and let you start our presentation here.
Thank you, Megan. And we're so excited to be here. We're going to get started now. And if we could see the next slide, please. We're going to get started by asking the first question. So, Jennifer, if you could tell us, what is estate planning and how do we benefit?
So first of all, Corrine, thank you for inviting me to speak today. And when it comes to estate planning means different things to different people. But when you break down estate planning to its most basic building blocks, it's simply individuals trying to figure out how their wealth, how their assets will be administered and managed, not only at their passing, but during their lifetime as well.
Okay. So how do wills work? And what do we need to watch out for?
One of the biggest misconceptions out there about wills or a last will and testament is that no matter what, these documents are going to transfer all of an individual's property upon their passing. Sometimes that's the case, and sometimes it's not. What participants need to keep in mind is that a will or a last will and testament is used to distribute or administer probate property. And when I say the words probate property, I mean anything that the individual owned on their date of passing that they did not own with another individual and that did not have a beneficiary designation attached to it. So for example, let's say upon my date of passing, I owned an investment account that had $100,000 in it. I was the only person on the title to the investment account. That investment account did not have any type of a beneficiary designation attached to it. Therefore, upon my passing, we have to figure out who is the rightful new owner of that individually owned investment account. So that account becomes part of my probate estate, and then that account is distributed according to the set of instructions or directions that I've put into my last will and testament. Another use or another important aspect of a last will and testament is that a parent is able to appoint or nominate a guardian. And that guardian is put in place if, God forbid, something should happen to both parents and they should pass away prior to their child or their children reaching age 18. In that scenario, if something should happen to both parents and there is a child or children under the age of 18, the guardian will be responsible for the physical care and comfort of that minor child or children.
So if we're speaking about minor children and we've talked about probate, can you describe what a trust is and then perhaps describe what a special needs trust is, speaking of children?
Sure. So when we talk about trusts, there is a lot of different types of trusts. I'm going to speak first about something called a revocable living trust, or simply a living trust. And this is a very common strategy or technique that many people have as part of their overall estate planning portfolio. With a revocable living trust, you're able to incorporate a set of instructions or directions as to how trust assets will be used or administered or managed, not only during your lifetime, but also upon your passing. What's great about a revocable living trust is that the person who creates the trust, he or she can make any changes they want to that trust document during their lifetime, so long as they're mentally competent. Also, what's great about a revocable living trust is that any assets or any property that is owned by that revocable living trust during the individual's lifetime, the individual still has complete control over and access to. Now, when the individual passes away, that revocable living trust, again, that the person could make any changes they wanted to during their lifetime, when that person passes away, the revocable trust now becomes irrevocable, meaning no additional changes can be made, which is actually a really good thing because you don't want someone else coming into the picture and changing the set of instructions or directions that you've put into that trust. And usually what happens, especially if you have parents that have children, they are going to determine or come up with a set of instructions or directions as to how trust property should be administered and managed for the benefit of their children, should the parents no longer be with us. Another added benefit of using a revocable living trust that actually owns assets or is funded is that on the day of the individual's passing, anything that is owned by that revocable living trust will not be subject to the probate process. And for that reason, revocable living trusts are often used as the core document within an individual's estate plan versus having the assets get transferred pursuant to the terms of the individual's last will and testament.
Okay, thank you. And can you discuss again, what is a special needs trust and where does
Sure.
that come into play?
So a special needs trust is a type of trust. It can be revocable or irrevocable. And the special needs trust, sometimes called the supplemental needs trust, will come into play when there is a family member or an individual who has some type of a disability where they are receiving services or financial assistance due to this disability. And we need to be very careful when that individual inherits assets, because if they inherit assets or property outright, then we run the risk of that individual losing access to whatever services or whatever financial assistance they had been receiving. So that's why using a special needs trust or a supplemental needs trust is a very important estate planning technique for parents of children that have special needs, or for anyone who would like to leave some type of an inheritance to an individual who does have special needs or some type of a disability and is either currently receiving or may receive at some point in the future access to services or perhaps some type of financial assistance because of that disability.
Okay, but what about if we have aging parents that may benefit from a trust? Are there specific trusts that we would talk to our clients about in that area?
So when you have a situation where an adult child would like to leave an inheritance to an aging parent, we need to be careful about the potential scenario where the aging parent is, let's say, in a nursing home or receiving Medicaid assistance because they are in that nursing home and they have spent down all of their funds. We need to be careful because if that parent receives an inheritance, particularly a larger inheritance, then that parent who may be receiving Medicaid assistance because they are in a nursing home and they've spent down all of their personal assets, that aging parent may no longer benefit, may no longer be able to receive Medicaid assistance. So in that case, using a supplemental needs trust may be beneficial because the supplemental needs trust is able to hold the assets or hold the inheritance. And in doing so, it is not going to supplant any type of financial assistance, such as Medicaid, that the aging parent may be receiving now or at some point in the future.
Thank you. Megan, can you change the slide, please? In the last 10 or 20 years, Jen, can you tell us, has the estate law changed? And do you think it might change in the future? And if so, how?
So when it comes to estate tax, we are looking at an ever-changing landscape. We typically see major changes or major overhauls to the federal estate tax system every 5 to 10 years. So for example, the current law we have in place, and again, this is at the federal level, this law will remain in place until December 31st of 2025. Assuming Congress does nothing between now and December 31st of 2025, new law comes into play on January 1st of 2026. And what's going to happen is the historically high federal exemption amount that we have in place, which is currently $12,060,000 per person, is going to be reduced significantly to approximately $6,700,000 per person. If you recall, last year, there was a lot of talk down in Washington, D.C. about changing current estate tax law and really having a situation where, again, we have this historically high exemption amount in place for federal estate tax purposes. There was talk about them lowering that federal estate tax exemption amount sooner rather than later. And to the best of my knowledge, that proposal is no longer on the table. So when it comes to estate tax law, this is something that we need to keep abreast of and figure out whether or not our clients' estate plans need to be updated to reflect changes with the state tax law. And that's really at the federal level. You do need to keep in mind that there are still a handful of states that still have separate state estate tax law in place.
Okay, so speaking of the states and the state tax laws, each state is different, but are there ways that we can avoid a state tax?
Absolutely. So there are different techniques and strategies that we can use with clients to try to alleviate or even potentially eliminate estate tax, whether it be at the state and or the federal level. And some common techniques involve trust planning, lifetime gifting, as well as charitable planning or philanthropic strategies. And I do want to point out that when it comes to estate tax planning, as well as estate planning in general, it is not a one-size-fits-all approach. Depending on your specific circumstances, your specific family circumstances or wealth transfer wishes, what may work for one person may not work for another, which is why it's very important to make sure that you are consulting with your financial planner as well as your estate planning attorney.
Okay, thank you. I'd like to move on to businesses. So Megan, if you could change the slide, please. Why would we need an estate planning attorney if we have a business?
What I find with business owners or entrepreneurs is that they are so busy building the business that they don't think about what's going to happen to the business when they're no longer here or no longer able to run that business. So with estate planning, when it comes to business owners, it's very important to figure out who is going to become the rightful new owner of the business interests, whether that be shares of a C corporation or an S corporation, or interests within an LLC or a limited liability company, or interests within a partnership. And if you don't have proper estate planning in place, what often happens is you have business interests that are getting transferred to family members, whether it be through an individual's last will and testament or trust, or maybe even the state intestacy laws. And these business interests are going to folks that really have no interest in the business. They've never worked in the business. They don't understand how to run the business. And you run into a situation where you have family members becoming owners of the business together with already established shareholders or partners or members. And that never works out well. So when it comes to business owners and estate planning, it's very important to figure out who should the rightful new owner of the business interest be when the business owner passes away. And there's different techniques that we can use to make sure that the business interests get to the right person in the right time, in the right manner.
So when we're talking about businesses, I've heard about funding a buy-sell agreement. Can you just explain to us briefly what a buy-sell agreement is and why would we want to look at that if we had a business?
Sure. So let's say, Corrine, that you and I owned a business. Let's say that we had an LLC or a limited liability company, and we each had a membership interest in the LLC. I pass away, and as part of the buy-sell agreement, you have promised my family that you are going to buy my interest in the limited liability company. So the question becomes, Corrine, where are you going to find the liquidity or the funds to purchase that membership interest? And there are different ways of doing this. You could use cash flow from the business. You could use personal funds. Perhaps you could take out a loan from a bank to purchase the membership interest from my estate, or you could use life insurance. Life insurance whereby upon my passing, the policy pays out either to you directly, Corrine, or to the business, and then you would use those policy proceeds to buy that interest from my estate, and then my family would in turn receive the liquidity or receive the proceeds versus having the business interest.
Okay, that's great. Megan, if we could switch the slides, we're going to switch gears here and talk about how a financial advisor and estate planning attorney work together. So, Jennifer, if you could explain why would it make sense for a financial advisor or financial planner and their consumer's estate planning team work in tandem? Why would we do that?
So when you think about estate planning is one piece of the financial planning process. So as an estate planning attorney, when you are creating the client's estate plan, you want to make sure that you're not doing so within a silo. You want to make sure as the estate planning attorney that you're effectively communicating with the client's financial planner so that you're both aware of what's going on, not only within the client's estate plan, but also within the client's overall financial plan. You want to make sure as the estate planning attorney that you're not recommending a strategy that's not going to mesh well with something that the financial planner has already recommended or is in fact implemented on behalf of the client.
So when we talk about the two organizations working together, can you give us some ideas or some situations where it would be more effective when the advisor and the attorney work closely together?
Sure. So let's say you have a situation where an estate planning attorney drafts a set of documents for a client. We want to make sure that we are circling back with the financial planner because it is imperative that we take a look at how the client's assets are titled, are owned, and we want to see whether or not there needs to be changes based upon the client's estate plan. One example is if the client had established a revocable living trust and avoiding probate is a priority, then we want to make sure that the client and the attorney are circling back with the financial planner to see which assets need to be transferred into the revocable living trust. Another example is when we're dealing with beneficiary designations on assets such as retirement accounts, like a 401k or an IRA, or beneficiary designations on assets such as life insurance policies or annuities. We want to make sure that both the primary beneficiary designation as well as the contingent or alternate beneficiary designation align with the client's overall estate plan.
And we're talking about estate planning. We didn't mention gifting. Can you describe what a gifting schedule is and who would see a gifting schedule?
Sure. So for individuals where estate tax may be a concern or a potential liability, whether it be at the federal level or more likely at the state level, one of the techniques that can be implemented is lifetime gifting, whereby the individual makes a gift, and it could be of real estate or other property or some type of money or stocks or investments, where they make a gift to another individual, usually a family member, or to a trust that's been established for the benefit of that individual or that family member. And what we're trying to do is effectively and efficiently reduce the value of the individual's overall estate. Because if we don't have as much money or as much property in the individual's estate, then we're not looking at as large of an estate tax liability. Each of us are able to gift up to $16,000 each year to as many people as we want. It doesn't have to be a relative. So if I wanted to, I could gift Corrine $16,000 right now. And there is no type of a gift tax liability. A gift tax return does not have to be filed. And again, I can do this every year to as many people as I want. Now, if I decided that I wanted to give Corrine more money than that $16,000 that I had mentioned, then I would have to file a gift tax return for the difference. And whatever that difference is would start to chip away at my $12,060,000 estate and gift tax exemption amount. And in that example, even though I do have to file a gift tax return because I am giving Corrine more than $16,000 in a calendar year, there is no gift tax due so long as I still have exemption left. Now, if I'm feeling particularly generous and I decide to gift more than $12,060,000 to Corrine or really anyone else, if I gift more than that, then the difference will be taxed at a flat rate of 40%. So for most people right now, given again, we have historically high exemption rates in place or exemption amounts in place, we are not concerned about estate and gift tax at the federal level. However, for folks who happen to live in one of the states that still impose a separate state tax, gifting can be a very efficient and very effective strategy to try to alleviate or even eliminate in some cases that state estate tax liability.
Now that we talked about gifting, I think this is a great segue to talk about generational wealth. So what happens to generational wealth when estate planning is not present or not robust enough? What happens?
So oftentimes we'll see generational wealth, for example, when wealth is going from a parent to an adult child, then from that adult child to their children. Oftentimes, if we do not have an effective estate plan in place, that wealth is eroded unnecessarily due to administrative costs, as well as estate tax and sometimes income tax as well. So really the takeaway with that is when you are transferring wealth from one generation to the next, it's very important to have an estate plan in place so that wealth is being transferred efficiently, effectively, and with the least amount of tax due, whether that be at the estate tax level or the income tax level.
And if I want to go back to the business, what other events or situations in a business will it make sense that a collaboration between an attorney and a financial advisor is beneficial?
So in this case here, let's say you have an individual who is looking to sell their business during their lifetime. And as a result, they're looking to transfer the sale in such a manner where they are trying to reduce their tax liability to the greatest extent possible. And also, due to the sale of the business, they are anticipating a large liquidity event. It is very important that the attorney that the business owner is working with to structure the transaction for the sale of the business, it's important that they are partnering or working in conjunction with the client's financial planner.
What about like in the event of like, I have a lot of clients that recently, unfortunately, have lost a significant partner. Would it make sense to work with the estate planning attorney then and in conjunction with the financial planning attorney at that point?
So in that situation there, if proper estate planning has not occurred, you may run into a situation where a spouse of the business owner is inheriting the business interest. And depending on the spouse's involvement in the business, that may or may not make sense. So in that case there, it's very important that the client's attorney, as well as the financial planner, are working together as partners to figure out the best course of action for that client, and really to help that client through this very difficult time, both personally as well as financially.
Well, thank you, Jennifer. Those are all the questions I have for you today. I'm going to bring it back to Megan. Megan?
Hey, that was fascinating. I loved it. I wish we had time for more questions, but I think you guys did cover most everything, and we are definitely out of time here. If anybody's questions did not get answered in the content of the talk, don't worry about it. We will reach out to you afterwards. And while we don't have the expertise at Advice Chaser to give you any kind of information on this, we'll definitely connect you with a professional who can help you. So on behalf of Advice Chaser, I'd like to thank Jennifer and Corrine and the organizations that have worked with us to bring you this webinar today. Appreciate your attendance here, all of our attendees. And you can look for an email soon with a link to a replay of this event. And you're welcome to share that with friends and family. So here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. So you can find out more by going to our website, advicechaser.com, and clicking on the link to find an advisor. Once again, thank you so much for coming, and we'll see you at another webinar soon.